This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only. Now, here's Shane and Deanna.
Hi everyone. Hi Shane.
Hi Deanna.
It's been a busy 2 weeks with a few central bank meetings. This week, the Reserve Bank of Australia met and kept the cash rate at 4.35%, and it's been at that level for the past 7 months. Some concern in recent periods that we might see a rate hike from Australia, or I guess a diminished chance of a rate cut in the next 12 months. What did you make of the statement from the board and also the press conference afterwards?
Well, to be honest with you, I thought the statement was a little bit more hawkish.
What do you mean by when you say hawkish?
Yeah, that's a good question. Hawkish means leaning towards another rate hike, or more concerned that they might have to raise rates again. If you say dovish, then that means leaning towards a rate cut. So if you take their commentary, if you go back to the May meeting, that's where they also left rates on hold, but that's the one where they were concerned about the higher than expected March quarter inflation numbers. And that one lent a little bit hawkish. There was some talk going into that meeting that the Reserve Bank may raise interest rates again. Some forecasts are still forecasting that. In the event the Reserve Bank left rates on hold because they concluded they've already done enough. And it was still a matter of waiting for that to work and bring inflation down. And they hadn't changed their inflation forecast for next year, which still see inflation going back into target. And of course, if you zip forward to this meeting, we've since had a higher than expected April inflation number. And it seemed as if the Reserve Bank, the statement and the press conference was again a little bit more hawkish, a little bit more concerned about inflation, a little bit more inclined to warn that, we may have to move again. That said, when the governor was pressed, she said it's still not clear which way rates have to go. So it's still very confusing.
And she actually said that the probability of a hike hasn't actually increased.
It hasn't actually increased.
Even though they discussed the possibility of hiking at this meeting.
That's right. And they certainly didn't discuss the possibility of a cut. So that in itself tells you something, that they're talking about either hiking or holding, not cutting. So all of those things suggest that they still have a hawkish bias. But you're right, you can read bits of what she said. And this is the problem with a press conference. If you put down comments on 2 pages like they have done for years after their meetings, for the last 34 years, there's less debate. But if you say things in a press conference, you could latch onto this comment or that comment. And economists, of course, were doing that. Some thought that nothing much had changed. Others thought that it was a little bit more hawkish. I noticed that when you look at money market expectations, the probability of a rate cut by the end of this year had diminished. And it was sort of pushed out again till next year. And of course, the rate cut is still not fully priced until well into next year, although that does move around a little bit. So a little bit messy there from the RBA. Our view, though, hasn't really changed. We still think that inflation will come down, that the economy we saw in the March quarter is close to stalling, that as a result, the Reserve Bank will be in a position to start cutting interest rates either later this year, that's our base case, or going into next year. So there's nothing in there that really changed our view, but it's just, I'm a little bit conscious there is that risk in the very near term, particularly if we get a higher than expected June quarter inflation outcome, that they may go again in, say, the August meeting.
Yeah, so she spoke about the August meeting a bit. A journalist asked her how many more high inflation prints would you need to see for a rate hike. I mean, she didn't really give us a number of actual data points that they would want to look at, but she did talk about the August meeting. I think it's obviously a clear risk that it's going to be a live meeting after the June quarter inflation data. I mean, I think that if the trim mean comes out at 1% over the quarter again, then they're probably likely to hike.
Yeah, I'd agree with that. That's where it was in the March quarter. If you get another one like that, then that would suggest it's maybe getting entrenched around the 4% annualised rate, which is well above what they want. Now, of course, we will see the Reserve Bank revise down its headline inflation numbers because of the cost of living measures that are getting rolled out, obviously federally and around the country in various state budgets. So things like energy rebates, free public, 50-cent public transport in Brisbane for 6 months, all those sorts of things will lower headline inflation. But the Reserve also knows that those things are temporary. What matters is ultimately what happens to the underlying picture, and there they focused on the so-called trimmed mean, which is a statistical measure. So if it comes in around 1%, then yes, we probably, or almost probably, will get a rate hike in August. But my inclination is to think that it will probably come on the lower side again. We have seen a pattern in the last 18 months or so. We get one strong quarter, then a soft quarter on inflation, then a strong quarter, then a soft quarter. So we saw a strong March quarter. Odds are we'll probably see a softer June quarter. That will then enable the Reserve Bank to leave rates on hold. Now, of course, it only becomes live, I think, if you get that higher CPI number. If you don't get a higher trim mean, then I think they'll leave rates on hold and just continue to warn that they still may have to move, but they might start to feel more relaxed about things again.
And on the state budgets, which you mentioned, Michelle Bullock spoke about that. Well, that sort of seems like the numbers coming out of the state and federal budgets in terms of their spending forecast over the next few years were probably a tad stronger than where the RBA would have hoped for them to be. Now we've pretty much had all the major state budgets. We've seen quite large numbers of spending from New South Wales, Victoria, South Australia, and Queensland, I think particularly in Queensland. Do you think that that's going to add to inflation in the next 12 months?
Well, it's a risk. So on the one hand, the governments have come out with these cost of living measures which pull down the headline rate. You do get a flow on to CPI items that are indexed to the CPI. So where like fuel excise goes up in line with the rate of inflation sort of thing. So if the rate of inflation is lower, then the rise in fuel excise will be less, which helps bring down future inflation, and there is an impact on inflation expectations. If inflation is pulled down to 3% because of these measures, that helps. Lower wages growth, for example. That said, if you look at it in terms of just pure stimulus, federal government, state governments, they're all adding more money into the economy. You do a chart which compares it from year to year, and we're going from fiscal contraction up until a year or so ago, and now we're going into fiscal stimulus.
Yeah, on that chart, the stimulus is worth about 1.2% of GDP in the next financial year. So that's pretty decent.
It is significant, and this is the point that many make, that on the one hand, you've got the Reserve Bank trying to get us to spend less, and on the other hand, governments around Australia are spending more. So that's like one hand, one foot on the accelerator, one foot on the brakes sort of thing. That makes the Reserve Bank's job harder. And so there's no denying that. And I tend to think that those who criticise governments do have a point on this front. And so that is also an issue, I guess, to some degree globally, but maybe not as much in other countries. That central banks aren't battling governments to the same degree. I think there is a bit of an issue there in the US, but maybe not in other parts of the world. So that's certainly a concern here and something you've got to keep an eye on. But I think the broader picture still is one of very weak consumer spending. And that will probably remain the case even despite these tax cuts, which will then make it harder for companies to put up prices and gradually pull our inflation rate down. And there is a little bit of light at the end of the tunnel. Our inflation rate followed other countries' inflation rates up. Our central bank then followed other central banks to tightening back in 2022, even though many of those other central banks started in 2021. Some of those central banks are now starting to cut rates, and things are firming up in the US towards a rate cut, which gives me a bit of optimism. Does it give you a bit of optimism that maybe there is a bit of light at the end of the tunnel there?
Well, the Fed meeting last week was, if you look at the statement, the summary of economic projections, which has the board members' forecasts on interest rates, growth, all the economic activity indicators, they revised down their interest rate forecast. So for this year, they now expect only one interest rate cut. And then for next year, they expect about 3 to 4 interest rate cuts. So that was revised down from 2 cuts. So in some ways, you can think that the risk of a cut this year has definitely moved down in the US. But at the same time, then if you listen to Powell's press conference, he still sounded like he wanted to cut 1 or 2 times this year. And it even seems like the September meeting for the Fed could be live. So I think Powell is sort of desperate to cut rates, maybe in a way to keep Trump out of office. I don't know. That's a conspiracy theory that some people have.
No, certainly not. Central bankers would never do such a thing.
He wouldn't be re-elected if it was a Trump presidency, as Trump has made it pretty clear. And I think also he just thinks that the US probably needs more support In the past few weeks, we've seen a number of indicators now around the consumer start to weaken in the US. So things like the initial jobless claims, which show that the rate of unemployment is likely to increase in the US. The unemployment rate has already gone up a bit to 4%. In the US, the retail spending data has been pretty soft. Consumer sentiment has been dropping. So even though the US has this much slower pass-through rate from interest rate changes to mortgage rates, because most consumers in the US fix for 30 years, they are still impacted through other interest rates like personal lending or credit card balances. And also, obviously, the broader economy is impacted by rising interest rates, especially in the business sector. So I think we're finally starting to see this weakness in the US consumer and therefore the US economy that we haven't seen in the past 2 years. So 1 or 2 Fed rate cuts to me still seems like a possibility this year.
Because the other thing that happened just before their meeting ended was the US CPI for, was that May? May came out and it was on the soft side.
Both in terms of core and in the headline.
And the headline. And then the PPI, Producer Price Index, inflation was also on the soft side, and imports, which caused US economists to say, well, it's quite possible the inflation measure that the Fed targets, which they call core PCE, that's an alternative measure of inflation based on a private final consumption deflator in the national accounts, it might come in at just 0.1% for the month of May, which I think would bring down the headline rate to 2.6%. So it seems as if the US, a bit like Australia, had this run of hotter inflation numbers in the March quarter, and then they've subsequently started to slow again, which likewise gives me confidence that the Fed is still on track to start cutting later this year. But it also makes me think, well, if the US had a big fall in inflation, it then sort of stalled out a little bit early this year. Now it's starting to resume on the downside again. Maybe the same thing will happen in Australia.
And if you look at the services components in the CPI data in the US that came out a few weeks ago, even some of the service areas like airfares and used car sales, medical costs, they've all started to soften. The only area that's really still of a concern is around shelter or rents, but some of the forward-looking indicators on that are a bit better. So the CPI data lags what actually happens in the real rental market if you're out there trying to get a rental right now. So I think that there are still definitely positive signs on the inflation story in the US, even though there's been some concern that shipping costs and transport costs are going up around the world, some high commodity prices as well, although oil has been coming down. So that's obviously positive for CPI, but I still think that inflation is going to slow further in the US and globally too.
Yeah, so do I. I think one of the things you notice as an economist, one of the things I've learned over the last 40 years as an economist is that economic data runs hot and cold. You go through these months where suddenly it surprises on the upside, partly because expectations are then fallen, and so everyone gets surprised on the upside. Then you go through a few months where it surprises on the downside. And of course, in an age like today where economic data is analysed to death and promoted in such a way, so it's very hard to get away from all this information. It seems like an ongoing soap opera with lots of noise out there. So I think the key for us as investors is to try and turn down the noise. But of course, for us as economists, unfortunately, or the reality is we have to look at this data and try and put some context around it. But the upshot for me is still that the broader picture for global growth is one of softening, similarly in Australia, and that's all consistent ultimately with inflation falling and interest rates coming down.
And there's also cases like the Bank of Canada and the European Central Bank who have started cutting interest rates despite inflation still being a bit higher than the central banks would like. They're definitely not at their target rate yet. Economic activity in those countries has slowed a bit more than it has in Australia, but not significantly. So Canada, similar to Australia, has a faster pass-through rate of interest rates to the mortgage holder. So these are economies where you do, I guess, have this potential for the central bank to cut rates, even though inflation may not necessarily be at the exact target rate that they want it to be.
That's right.
And the European wages data is still much higher than Australia. They're running at about 5% annual wages growth. Here, our wages growth peaked at 4% and it's likely to come down from here.
So that's the thing. I think the governor of the Reserve Bank is right to point out there are some differences. They've got higher unemployment in both of Canada and the ECB, but they've also got higher wages growth. So you could argue there's swings and roundabouts when you make those sorts of comparisons. I mean, the bigger picture, I think, is that these countries, moved their rates up with inflation, just like Australia did. Now they're in a position to start cutting them, which ultimately does tell us that rate hikes do work in slowing inflation, and ultimately that sets up a scene for lower interest rates. Anyway, I think that's it. Have a good one. Thanks, Deanna.
Thanks, Shane.
For more info on Shane and Deanna's podcasts and reports, head to the Insights Hub at amp.com.au.